Welcome to the Pro Ticker Deep Dive. We are jumping straight in today, looking at what our sources are showing as a really critical inflection point. Uh, uh, Globally, I mean.
Yeah, a moment of convergence, you could say.
Exactly. And we want to analyze what that convergence means for, well, local stabilization efforts, especially in places like Brazil.
Hmm.
For the better part of a year, maybe longer, it feels like the global economy has been holding its breath, waiting, just waiting for those dramatically higher interest rates to really land, to actually, bite into activity.
And now it seems like, well, we're seeing the evidence. The brakes are working.
Right. So we're shifting gears.
Yeah.
Fundamentally shifting gears worldwide.
Moving away from that really aggressive fight against inflation.
Something more delicate, managing the slowdown that follows.
That's the transition. And that's our mission today, really, to trace this movement.
Okay.
We need to see how these global monetary decisions are sort of coming together, converging, and use the data we have to see how economies like Brazil are reacting to this collective brake check.
It's fascinating because this shift is creating these immediate ripple effects, isn't it?
Absolutely. Across currencies, capital flows, it's basically setting the whole financial stage for 2026.
Okay, let's unpack this then. I think we need to start with that big global picture first.
Agreed. The macro backdrop sets the scene.
Because understanding the U.S., its resilience, that seems key to everything else.
It really is.
So let's look at that global brake check scenario, and then we can zoom into the specifics locally, maybe in Latin America.
Sounds good. So the macro backdrop, the narrative is pretty clear now. We're managing the slowdown.
Not fighting inflation anymore.
The policy tools have changed. We're not talking about aggressive tightening now. It's more about anticipating when and how easing might begin.
But the U.S. economy, it just keeps surprising people, doesn't it? The pessimists, anyway.
It does. It's certainly decelerating, no question, but it's resilient.
I'm still kind of amazed it's that resilient. How are they managing that with money being so expensive?
Well, it's an interesting split. The resilience isn't really coming from the sectors you'd expect, like housing, which are sensitive to credit costs.
Okay.
It's being driven by two sort of powerhouse factors. First, consumers are still spending. Consumption is holding up. And second, maybe even more important, is this massive wave of AI-fueled corporate investment.
Really?
Companies are just pouring money into tech, infrastructure, automation, trying to capture those AI efficiency gains.
So high rates are maybe cooling down Main Street borrowing.
But big tech CapEx is running hot, and that's kind of offsetting the drag.
Exactly.
That corporate investment helps keep growth going, keeps employment pretty firm.
So what are the projections looking like for the U.S.?
Well, growth for 2025 is projected at a, pretty solid 1.8%.
And the Fed, what's the thinking there?
Crucially, the sources are noting the Fed has already started signaling a policy ease. They're targeting maybe a 3.75% funds rate by the end of 2025.
Okay, connecting the dots then.
Yeah.
That Fed shift, that's the really crucial supportive wave we need to watch, right? For everyone else.
Absolutely. Think of it like a huge tailwind for emerging markets.
How so?
Well, when the Fed signals easing, or actually starts easing, two big things tend to happen. The dollar usually softens.
Makes imports cheaper, helps with inflation globally.
Right. And global liquidity improves. It just becomes easier to access capital.
Which reduces funding costs.
Exactly, especially for dollar debt. And it dramatically improves risk appetite for EM assets. It's like an injection of confidence in capital.
Okay, makes sense. What about the other big players? Europe, Asia, they seem to be moving at different speeds. More sluggishly, maybe?
They certainly are. The Eurozone, well, growth there is projected to barely hit 1%.
Wow, just 1%.
Yeah. They've got this dual challenge. Inflation is easing, but it's still persistent, and the economy is pretty fragile.
And there's a complication, right, with defense spending.
Yes. Higher defense spending is giving a bit of a short-term fiscal boost.
But that raises worries about debt down the line.
Definitely. And it looks like the European Central Bank has basically paused its rate cut cycle for now, letting fiscal policy do some work.
And China. Their strategy feels almost strategically different from everyone else.
It is quite different. China's focus is really squarely on industrial policy and exports.
Right,
They're
manufacturing.
leveraging their manufacturing scale, finding new markets, shifting supply chains into ASEAN, boosting exports to Europe, kind of offsetting slower U.S. demand.
Plan their growth.
Expected around 4.7% in 2025. But importantly, that growth favors manufacturing scale production. Not so much domestic consumption-led expansion.
So globally, it's a really mixed picture. U.S. relatively strong, Europe weak, China strategically focused on manufacturing. How does this divergence play out across Latin America?
Well, it really highlights the diversity within the region itself. You see this varied picture clearly.
Like Mexico.
Mexico's looking pretty benefiting from nearshoring trends, but inflation pressures there are proving quite sticky. Chile, meanwhile, is holding back on more rate cuts. They seem worried about persistent price pressures, cautious about undoing their progress.
And Argentina.
Argentina, of course, continues to face significant political turbulence. That just clouds the whole economic reform picture.
Okay, let's bring the focus specifically to Brazil now, because this is where the policy intervention, the tightening, has been maybe most dramatic.
It has been very significant.
And that tightening cycle, anchored by the Selic rate, it's clearly inducing the stabilization people are waiting for. How's that high rate actually performing? And, what cost?
Well, performance-wise, if your measure of success is taming inflation, it's performing exceptionally well.
Okay.
The Selic rate is still one of the highest real interest rates globally.
Just remind us quickly what the real rate is.
Yes. It's simply the nominal rate, the headline number, minus the expected inflation rate. So it's the true return on your money after inflation.
Got it.
And by keeping that real rate high, it's definitely doing its job, cooling down demand, anchoring expectations.
But the cost of that stability has to be slower growth.
Precisely. And that slowdown is deliberate. It's necessary. The growth projections show this.
What is it?
GDP growth expected around 2.0% in 2025, then dipping to a slower 1.4% in 2026. That downward revision shows the high rates are, successfully putting friction on the economy.
And inflation itself, it cooperating?
It is, thankfully. It's easing toward 4.5% in 2025 and then projected down to 3.8% in 2026.
And 3.8%, that's significant because...
Because it means core consumer prices are right within the upper bounds of the central bank's target range. That's a huge success compared to the peaks we saw earlier.
Is anything else helping contain prices beyond just the high interest rates? I feel like currency strength was also a big part of the story.
Absolutely key. You're right. The projected stronger currency, the real, provides immense disinflationary support.
How strong are we talking?
The projection is for it to reach around 5.25 cents per U.S. dollar by the end of 2025.
And that helps
because that strength acts like an immediate brake on imported inflation. Every imported good just gets cheaper. It's a powerful extra tool helping bring inflation down.
So we're seeing stabilizing trends more broadly then, not just in prices.
We are. Things like business surveys, industrial confidence, they're clearly showing a cooling trend.
And the job market.
Crucially, the labor market seems to be flattening out. We're seeing stalled employment gains. Wage growth is moderating.
Which helps contain domestic price pressure.
Exactly. The classic sign that overall demand is cooling off.
Okay, that sounds like a, almost textbook stabilization story.
Yeah.
But there are always vulnerabilities, aren't there? What are the key risks we need to flag in this local picture?
The main one really is the sizable current account deficit.
Explain that quickly for listeners.
Sure. A current account deficit basically means the country relies on borrowing money from abroad to pay for its imports and service its existing debts.
Okay. And the risk?
It makes the local economy quite dependent on volatile portfolio flows. That's the short-term, sometimes fickle money from global investors.
So if global sentiment sours,
that reliance becomes an immediate risk. For the currency, for inflation, everything. Those flows can reverse fast.
Okay, so they really need external investors to stay confident. On the flip side, though, the sources suggest the government's own finances, the fiscal side, is looking better.
Yes, that's the other side of the coin. The fiscal accounts appear manageable, actually.
How so?
Debt stabilization is projected near 80% of GDP for next year. Assuming, and this is important, assuming the current revenue-raising measures actually hold up.
And why is that fiscal discipline so crucial?
Because it gives the central bank credibility. It lets them focus purely on monetary policy, on fighting inflation, without worrying that an unstable government budget is going to destabilize everything anyway.
Right. Okay, let's pivot now sharply, maybe, to the investor view. If you're a fund manager looking at all this, what's the trade? What does this all mean for the markets? For the traders paying close attention?
Well, it means that high Selic rate, which is expected to be held steady at 10.5% right through 2025, that acts as a very powerful high-yield anchor.
An anchor.
Yeah. Because inflation is slowing down towards 4%, The resulting real interest rate, remember, is highly attractive. It makes Brazil one of the world's best high-yield fixed income destinations right now.
And that's what pulls in the famous carry trades we always hear about. We should probably quickly define that because they aren't risk-free.
Good point. No, they're not. A carry trade is essentially when investors borrow money in a currency where interest rates are really low, think the Japanese yen, for example.
Okay.
And then they invest that borrowed money in a currency where rates are high, like the Brazilian real. They pocket the difference in interest rates.
Sounds easy.
It is, until it isn't. Because the real offers such a high real rate, it's incredibly appealing. But the big risk is always currency volatility. If the real suddenly weakens, those investors can lose money fast, and they tend to rush for the exit all at once.
Let's look at the technicals then, the trading context provided.
Yeah.
How is this relative optimism playing out in the actual currency market?
Well, the USD-BRL pair, the dollar versus the real, it seems to be facing resistance near 5.40.
So struggling to get weaker than 5.4 reais per dollar.
Right, and it has strong support around 5.2. That range kind of reflects the overall confidence in the monetary policy credibility.
And what would be a significant move?
A sustained technical break below 5.20. That could signal renewed confidence in the macro picture. It could potentially open the door for a run towards $5.
Which would be a huge boost, psychologically and financially.
Absolutely.
Okay, what about stocks, equities? Are domestic stocks benefiting from this stabilization picture?
We're seeing an interesting rotation, actually, a structural shift.
Away
from the rate-sensitive small caps. You know, the companies that really rely on cheap domestic credit to grow.
And towards
exporters who benefit from global demand, and also towards those AI-related infrastructure names.
Mirroring those global tech capex trends we talked about in the U.S.
Exactly. So it's a kind of risk-on environment, but a selective one. Investors are being picky.
Now, the bond market, often seen as the smartest money in the room, predicting where the central bank goes next. What's the yield curve telling us about future cuts?
It's signaling exactly what you'd expect in this kind of high-rate environment that's heading towards eventual easing. The yield curve is flattening.
Explain flattening quickly.
It means the difference between short-term interest rates and long-term interest rates is shrinking.
And that's a classic sign
that markets are pricing in slower growth now, but they anticipate eventual and significant monetary relief later.
Can we quantify that? How much easing is priced in?
Specifically, the curve seems to imply around 150 basis points. That's 1.5 percentage points of cuts by the end of 2026.
Which would be consistent with?
Consistent with a Selic target, eventually settling somewhere around maybe 11.75% after the easing cycle gets going. Correction. The target would be lower, closer to 9.0%, 10.5%, 1.5%. The source text might have a typo here. I will use the implied target from the basis points. Consistent with a Selic target eventually settling closer to 9.0% after the easing cycle begins.
Okay, so the setup heading into 2026 seems to offer both, well, significant upside potential, but also reasons for caution.
Definitely. If we connect this all back to the bigger picture, the major opportunity is clearly that monetary relief, the rate cuts.
When might those start?
Our baseline suggests cuts could potentially begin maybe mid-2026, once those inflation expectations are really firmly anchored at the target level.
And that pivot, when it comes, would be powerful.
Hugely powerful. It could revive credit demand, stimulate investment again, bolster consumer confidence all at once.
And let's not forget the global tailwinds we discussed earlier.
Right. Emerging markets in general are benefiting from that favorable capital flow picture, partly thanks to the Fed starting to ease.
Combined with that robust AI-driven growth in the U.S. tech sector.
Exactly. That tends to lift all boats, potentially boosting asset prices across peer economies like Mexico, Chile, and Brazil too.
Okay, but we have to be diligent about the risks. You said the baseline is constructive, but far from bulletproof.
Correct. We see three key risks really worth flagging.
Risk number one.
Stronger than expected domestic growth, which sounds good, right?
Yeah, counterintuitive risk.
But it could, ironically, delay monetary easing if it causes inflation to flare up again. The central bank would just be forced to keep the brakes on for longer than the market hopes.
Okay. Risk two.
The governmental side. Fiscal fatigue.
Meaning the government just gets tired of being disciplined?
Pretty much. Any slippage in meeting those primary balance targets or failure to hit revenue goals that could quickly reignite all those debt concerns and shatter investor confidence.
Doing all the hard work. Okay, and the third risk?
External shocks. Always a risk for emerging markets.
Like what?
A sudden reversal in global risk appetite, maybe driven by geopolitics somewhere else, or another financial scare. That could trigger an immediate outflow of those volatile portfolio flows we talked about.
Which would cause the currency to weaken.
And instantly undo a lot of the hard-won progress on inflation.
Right. So the conclusion seems to be, well, the baseline looks constructive. Real progress towards stabilization is being made.
Yes.
But that stability really hinges on continued discipline, both political and monetary.
Absolutely.
So patience seems like the winning trade right now. Investors just waiting for that easing cycle to finally begin, maybe mid-2026.
That seems about right. Whether the next chapter is one of sustained disinflation and this gradual recovery, or whether we see renewed turbulence. It really depends primarily on two things: fiscal discipline at home and economic resilience abroad. So, maybe a final thought for you listening. Consider which of those two factors, domestic discipline or external resilience, feels more stable or perhaps more precarious in the current global environment as you think about your own strategy.
That's a great point to ponder. Thanks for guiding us through this deep dive into monetary policy, the global slowdown, and the path towards 2026. See you all in the next Pro Ticker Deep Dive.